There may be over 500 tons of gold sitting inside Indian homes right now. Not in banks, not in businesses, not in the economy, just locked in lockers. And in February 2026, that could be one of the biggest financial mistakes middle class India is making. Gold is hovering near historic highs. Global price fluctuating around $5,000 per ounce. In India, physical gold premiums are volatile. Meanwhile, Reserve Bank of India maintaining a cautious stance on inflation. Nifty 50 showing volatility after strong 2025 rally. Dud SIP inflows still near record levels as per Association of Mutual Funds in India data. Outside jewelry shops, long queues. Why? Two emotions. One, FOMO, fear of missing out. Two, fear of economic collapse. But here's the uncomfortable question. Is physical gold still the smartest way to protect wealth in 2026? Don't answer yet, because the truth is not simple. Why gold is rising? Let's be fair. Gold didn't rise randomly. Ukraine war continues. Middle East tensions persist. US rate cycle shifting. Central banks, including RBI, increasing gold reserves. BRICS de-dollarization discussions. When uncertainty rises, gold rises. That's history. But here's the pattern interrupt. Gold rising does not mean buying physical gold is smart. They are not the same thing. Gold as an asset class is not equal to gold as jewelry under your bed. The middle class example. Let's take a typical Indian household. Income 72,000 rupees per month. Savings capacity 15,000 rupees per month. Existing savings 8 lakh rupees in FT, 3 lakh rupees in gold. No equity exposure, they feel safe. But inflation at 6% means 10 lakh rupees today becomes worth approximately 5.7 lakh rupees in 12 years in real terms. Gold protects purchasing power. But physical gold does not generate yield, no dividend, no interest, no productivity. It just sits. And that's the problem. The opportunity cost nobody talks about. If 10 lakh rupees is kept in gold, return depends only on price appreciation. But if 5,000 rupees per month is invested in Nifty 50 index fund at 11% CAGR for 25 years equals 94 lakh 72,000 rupees. At 9% CAGR equals 67 lakh 89,000 rupees. That's the compounding difference. Now here's the February 2026 reality. Nifty valuations are not cheap, but they are not bubble territory either. If you systematically invest through SIP, volatility becomes your friend. India imports gold. More gold demand equals more dollar outflow. USD over INR pressure increases, which means imported inflation risk. Pressure on forex reserves. Potential currency weakness. If RBI has to defend INR aggressively, liquidity tightens, which hurts equities temporarily. Everything is connected. Gold is not isolated from the economy. It affects it. Thanks to Securities and Exchange Board of India regulations, today you can invest in gold ETFs, sovereign gold bonds, gold mutual funds. These are transparent, tax efficient in some cases, no locker cost, no making charges. That's how developed markets do it. Physical gold as primary strategy? That's 1980 thinking. Rajiv, 32 years old, bought 4 lakh rupees gold in 2023 during surge, held till 2025, gained 35%. His cousin Mehul invested 5,000 rupees per month in equity mutual funds since 2018, despite 2020 crash, despite 2022 volatility. CAGR approximately 12.3%. Corpus today, approximately 8.6 lakh rupees. Rajiv's gold, 5.4 lakh rupees. Mehul didn't predict markets. He followed discipline. Gold protects, Equity multiplies. Both have roles, but not equal weight. In 2026, here's a rational allocation approach. If you have 100% investable corpus, 25% gold, prefer ETF or SGB over physical. 40% equity, SIP in Nifty 50 plus flexi cap. 20% fixed income. 15% other assets, REITs, etc. If you're young, stable job, high risk tolerance, gold max 20 to 30%. Not 60%, not 70%, not all in. Because remember that 500 tons locked in homes, it's not compounding, it's sleeping. And sleeping money never builds financial freedom. What percent of your portfolio is in gold right now? Let's discuss whether that allocation makes sense in 2026. Markets are transitioning. If global volatility spikes again this year, asset flows will change fast. Review your allocation this week, not next year. Subscribe now because 2026 will reward informed investors, not emotional buyers.